I'm joined today with my favorite economist, Odeta Kushi. I think we're making it a quarterly podcast recording to talk about the economy because there's so many things going on, going wrong, and going right. And to unpack everything, I always rely on Odeta's opinion. And she's such a well-known person in the industry. And for folks that don't know Odetta, Odetta is the deputy chief economist for First American. And from Odetta's perspective, she has a inside view of what's going on with the housing market, since First American is the top insurer and a company that provides title services. So through First American business, you have things like number of mortgages originated, the rates, the locks, applications, the geographical data. So all of that data is at fingertips of Odetta, and but it still makes me wonder. With all this data, we don't know what's going on in the future. So Odetta, I wanted to invite you again, and hopefully you can clear some questions that my audience have about what's coming in the future. Are we in recession? In fact, you were at the conference this week, so am I, and I didn't hear the word recession a single time. So maybe, maybe it's not there. But let's talk about what's going on with the labor market, with the inflation, with the Feds, and anything new that you have for us today.
Absolutely. Well, thank you so much for having me. It's always a pleasure to come join you and happy to make this a quarterly thing. There's definitely enough going on to have new material and substance to talk about. And to your point, there's just, there's a lot of moving pieces happening in today's economy, and all of it impact the housing market. So I'm glad to be here.
Perfect. So where do you want to start? Do you want to start with the Fed's inflation? That's your usual starting point, right? So let's start there. And we had the rate cuts in September. We expect the rate cut in December or first quarter. I think MBA expected um, 50 basis point cut, um, and overall 75 basis points, including the 25 basis point cut by Fed. But they have no data, right? So government shutdown, they have very limited data. So what alternative sources do they use, and what do you expect from Feds on the next meeting?
Yeah, that's a really great point. I mean, we are officially in the longest government shutdown in the history of the US. The last one was in 2019 period. And I think as of today, we're entering the 37th day of the shutdown as we're recording. And that certainly has implications for the broader economy. But to your point, it also has implications for the Fed that is heavily reliant on these government data sources that are comprehensive and timely, like the jobs report, which we're supposed to be getting today, and we are not. So the Federal Reserve is now relying on private sector data, and there's a lot of that, and it is very, very helpful. And I'm happy to support some of my conversation with some slides because
Let's do it.
they are with
Absolutely.
me everywhere I go. So let me start. I'll share my screen really quickly, and hopefully you can see that. And okay,
We can.
so
Perfect.
let me just start with where we're at. And I want to be mindful of the fact that some of the data we're showing, so here in particular, we're looking at August data because that's actually the latest we have from the government data sources. That's the last available PCE, Personal Consumption Expenditures report, and also the last unemployment report that we have. And as of that date, the PCE inflation, the core PCE, which is what the Fed really tracks, was at 2.9%. And it's really been sticky at this level for some time. And as a reminder, the Fed's goal is an inflation rate of 2%. So we haven't really fixed the inflation problem yet. And then on the unemployment side, the Fed's unemployment rate target is right around, I would say, 4.2%. When you look at their long-run forecasts, that's really where they have that unemployment rate at is 4.2%. And in August, we were at 4.3%. So pretty close to where the Fed wants us to be. So on the surface, it looks like we're okay on the labor market. Inflation, we still have to fight that fight. Now, we did get the September Consumer Price Index inflation report. So we have some insight into what's happening with inflation through September. And I thought that report was very, very interesting because when you decompose inflation into its parts, so goods inflation, which would be the piece of inflation that's the most impacted by tariffs, that's actually trending in the wrong direction. So we see that the green line here, the goods inflation, historically, it's like right around zero or even negative. So goods can even be in deflation over time. And unfortunately, we're sort of trending in the wrong direction right now. The good news is that super core services inflation is trending towards its historical average. And similarly, shelter inflation is still elevated, but trending in the right direction here. So,
So that's expected, right, Odetta?
yeah.
I mean, with the tariffs, we expect to see some bump in the inflation for the goods, and everything else, housing prices seem to start dropping.
Yeah, and actually, there was a really interesting analysis by the Federal Reserve that was looking at just how much of inflation can be explained by tariffs, and what they found was that over the June to August 2025 period, tariff explains roughly 0.5 percentage points of the headline PCE inflation. So what that means is that core PCE measure that I just showed in the previous slide, which was about 2.9%, it would have otherwise been 2.5% without tariffs. So, that part is something that the Fed has to deal with. But the good news there is that the economics literature tends to look at a tariff as a price shock, a one-time inflation hit. So that at least the literature says that, but of course there is an argument to be made and to consider that there could be more persistent effects from tariffs. But the Fed can potentially see through the tariff impact if it's going to be just a one-time hit to inflation. And inflation is just the growth rate. So you can still have the price level remaining high, but they can maybe see through the tariff impact, hoping that inflation will eventually come down. And I think the other thing to think about here is super core services. Super core services is very dependent on wages, right? So the service sector is very labor intensive. And so typically when we see services inflation accelerating, it's because we're seeing wage growth pick up. In today's economy, and we'll talk a lot more about the labor market, we're really not seeing a lot of upward pressure on wage growth because there's not a lot of hiring going on. People are really staying put at their jobs. The quits rate is very, very low. And when you see a quits rate that's very low, that means people aren't feeling very good about their ability to get a higher, better paying job. So we're not expecting a ton of upward pressure on wage growth, which means there's some reason to believe that super core services inflation will continue to trend towards historical average.
Yeah, would love to dive in, but let's get to it when we get to it. So
Yeah.
so that's understood, and I think just to final thought on Fed's rates. If you look at the long period of time, I think the inflation is averaging around 3.5%. So having a inflation at three is okay in my mind, and I think Feds are okay with it as well. I mean, 2% inflation is really a not achievable target in my mind. What do you think?
Well, I think from the Fed's perspective, they want to anchor us to a number because if they can anchor us to 2%, then we can anchor our inflation expectations. And we feel like the Fed has a handle on inflation. And that's really important. Inflation expectations from a consumer's perspective are very, very important. And the belief that the Fed has it under control is very, very important. And so, even in his speeches, Powell continues to reiterate that the target is 2%. We want to achieve that target. That is still the Fed's goal.
Understood. Okay.
Now,
So
one
go ahead.
one other piece here, and this sort of my little early intersection into the housing market, is we mentioned shelter inflation. Shelter inflation is very much dependent on rent. The way that the CPI captures shelter inflation is not really by looking at the purchase market, it's by looking at rent. And it tends to it looks at overall rent in the economy, not just rent on new leases. And so we can forecast shelter inflation with a pretty high degree of certainty because we know from the private sector data what's happening with rent on new leases, and we know that rent growth on new leases is slowing, and so we can expect that shelter inflation will drift towards historical averages as well. And I did want to bring up that all real estate is local, and so rent growth does depend on where you are in the country. So in this chart, I'm actually showing you annual rent growth on the y-axis, and then how much we're building relative to the existing inventory. So where do we have sort of excess stock of multifamily supply? And you can see there's a pretty strong relationship between these two things. So in areas where we're building a lot relative to the existing stock of inventory, these are places where we're seeing downward pressure on rent. So think, Florida, Texas, Arizona, Charleston, right? These are markets that are now seeing year-over-year declines in rent. Then, you've got my hometown of Rochester, New York, where we're not really building very much, and so rent growth is still positive.
Where do you see New York City on this chart?
New York would be right here, I think, right? This giant, we don't call it out because there's too many bubbles, but it's in our northeast. It's pretty big, so the population's very high. So I think it's just in the low single digit positive growth
It's going to
territory.
be interesting post-election of New York mayor. I'm sure that the agenda of Mamdani is to drive the rents down, and I guess a lot of the investors are eyeing that little circle that you show in New York, which shows 2% growth year over year, but certainly investors are all freaked out about that circle moving down to the negative territory.
Well, this yet another reason to keep these quarterly meetings, right? So we can track this little chart over time because as of right now, there's a clear regional divide with those northeast Midwest markets still seeing positive rent growth because we're just not building as much multifamily, whereas the southern and western markets, Sun Belt in particular, are seeing downward pressure because we've been building in those markets.
Makes sense.
So, yes, rent growth is slowing, but it really depends on where. Finally, on the labor market, I think I may have shown this chart last time we were together as well, because I still think it's incredibly relevant in that the unemployment rate is still historically low at 4.3%. But the reason for the unemployment rate's slow increase over time, consider that in 2023, the unemployment rate was actually 3.5%, very, very low. Today, it's closer to 4.3%. But the big driver of that increase has been permanent job losers, which I think is the most recession relevant component of all of these drivers that you see here. Believe it or not, you could have an increase in the unemployment rate for good reasons, like there are more reentrants to the labor force. People are feeling really good about their prospects, and so they're choosing to reenter the labor force. But unfortunately, it's this red category that's driving the bulk of that increase. And I should mention, since we brought up private sources or alternative data sources on the labor market, we can actually track the real-time unemployment rate. There's been other sources that have come up that have shown that the unemployment rate in October hasn't moved that much. It's like 4.35% from the last official source from the government source in August, where it was 4.3%. So we're still not seeing the unemployment rate increase that much. But one of the reasons for that is because the break-even level of employment is a lot lower. And what I mean by that is there's been a bunch of different estimates on what that number could be, but let's say that the break-even level of unemployment last year was, 100,000 jobs. This year, it could be 30,000 jobs, which means we could see very few new job growth, but it's enough to keep that unemployment rate steady because of, lower immigration, slower population growth, all those reasons.
So let's dive into this chart a little bit. First, let's think about AI. Does AI impact the unemployment rate? Last data sources I saw probably at the end of the summer, the AI contributed only a few percentage towards the job losses. In this quarter, there were big announcements by Amazon, by Microsoft, by Facebook related to AI that would cause some of the job losses, while the racks for hiring to fill in some of the software developer positions for Microsoft and Facebook and Amazon's are still open, right? So, do you see that AI is a big contributor to the red category here as a permanent job loss, or you think it's just a mismatch of skills for the labor force available on the market?
Yeah, I think I've also seen the anecdata around AI layoffs or maybe cited as a reason why you don't need as many workers in a given company because of AI. The flip side, of course, is that AI could also provide productivity boosts and ultimately productivity led wage growth in the economy. I think the jury is still out on what the AI impact is on the labor market right now. I would say the permanent job losers category is we're not seeing a lot of hiring in today's economy. There's still a ton of uncertainty from firms, especially, some of the smaller businesses around what the future will look like. And so, not a lot of hiring going on. So, when people lose their jobs, they're having a really difficult time finding something else, another opportunity. And that's, I think, been the real challenge in today's labor market.
Yeah, just to comment on that as well, from yesterday's conference in DC, um, top three banks in the United States commented that they are not hiring because they would utilize AI to do the same functions and actually scale the business with the same staff, right? So there's no extra hiring involved. And in my mind, that translates to not hiring students, right? Folks that are uh, recent graduate of colleges. In fact, my firm receives constant phone calls from the colleges or from the students or from the parents, if asking if we're hiring, and the answer is no. I mean, we're substituting a lot of the basic data entry and blue collar functions with AI. Does that translate to your chart somehow here?
Yeah, I think that's exactly what we're seeing is that the labor market is most challenging for recent grads, for younger people, and for recent grads. And similarly, a lot of the roles that have been replaced by AI are entry level data analyst type positions, where you would see that position being filled by a younger, new college grad. And so I think that does align with what I'm seeing and hearing as well.
Okay. And by the way, MBA projects next year 4.8 unemployment rate. Is that what you are showing as well?
Consensus is all over, but I think 4.8 is very much in the ballpark of a reasonable estimate for next year.
Okay. And that does not translate into, call it, recession next year, right? Or we just
It
don't know.
depends. We don't know. I think recession and the way that we define recession is the depth and duration of deterioration in the economy across multiple measures. Of course, the labor force being or the labor market being a key indicator, but beyond that, retail sales, consumer spending, income, all of these different measures. But certainly, 4.8% is trending in the wrong direction and indicative of stress in the labor market for sure.
And I'm sure you have slides showing about consumer spending, and let's go there too. So that's a good
That's what the slide for.
oh, of course, you have a slide for everything.
Exactly. Yeah, we've already talked about this, so I won't spend too much time, but, I also look at the job openings and labor turnover survey, which I think is just confirming a lot of the things that we've talked about, which is job openings have trended lower. The hires rate in today's economy is at about 2013 levels, which is when the unemployment rate was 7%. The quits rate is historically low. So again, people are not leaving their jobs because they don't think there are a ton of opportunities out there. But I will say that the bright spot in this report has been that the layoffs have still been historically low. And I think that's a really important point because if we do start to see massive layoffs in the economy, that's when I get worried about the unemployment rate increasing significantly because there's just not a lot of positions to absorb those layoffs. And as I mentioned, the Chicago Fed real time unemployment rate forecast for October was 4.36%. I got to get those decimal points. But so it's not. As of right now, the unemployment rate hasn't moved significantly higher, but I think if we start to see more layoffs, that certainly becomes a concern.
Is the labor market shrinking, or it still remains flat?
So the labor supply is where immigration obviously has, come down significantly. And that has been one of the drivers of why that break even employment level has come down.
Okay, makes sense.
Since you mentioned consumer spending, we
Yeah.
just got new data from the New York Fed Consumer Credit Panel uh, a couple days ago, or yesterday actually. And I always like to bring up this chart because it's showing you credit card debt in nominal and inflation adjusted terms, and then the delinquency rate on that credit card debt. So in the US, consumer spending has actually been surprisingly resilient, supported by real wage growth and a pretty resilient labor market. But some of that spending is being financed with credit. Credit card balances rose by $24 billion in the third quarter of this year and are now about 6% above levels from a year ago. At the same time, the share of credit card balances that are 90 days or more past due, so that's what we consider the late stage delinquency rate, at the highest level since 2011. So that tells us that repayment burdens are rising. We also know that the strain isn't being felt equally. We know that delinquencies are most acute among lower income households who tend to have less of a financial cushion. And so while the overall economy continues to show resilience, I think that the rise in the serious credit card delinquencies is a bit of a warning sign that some parts of our consumer base are under pressure, and that matters for recession risk because consumer spending is 70% of economic growth in this country. So we need consumers to be gainfully employed and confident enough to keep spending.
Yeah, one of the things that I do hear about, folks that are receiving SNAP benefits, folks that are receiving government assistance, they have no choice but to max out the credit cards and go into delinquent until the government reopens, and then that certainly is pretty unfortunate, and I'm hoping that the shutdown will end before Thanksgiving, and things will get back to normal. But that's exactly what I think will drive the delinquency rate as well, this quarter at least.
That's a great point. I mean, the longer that the shutdown goes on for, I think the bigger the risk to the broader macro economy, and we're sort of now in uncharted territory because of how long it's been going on for, and big question mark around when it will end.
Yeah, agreed.
And in terms of what this all means for the GDP, I know we all like to look at just the overall GDP growth in the economy, but that growth can swing based on imports, exports, um, and inventories. And so instead, I like to look at a measure called real final sales to private domestic purchasers, which is sort of just capturing like underlying demand in the economy. And when we were building this chart, we sort of realized, wait a minute, every time this year-over-year growth rate dips below 2%, we seem to enter one of these, gray recession bar areas. It seems to be highly correlated that when we start to see growth below 2%, we enter a recession. So we started tracking this, and of course, there are some false flags here. Like we briefly entered this period here, and we didn't see a formal recession. But the good news here is that while this seems to be trending lower in the latest data, that this growth is 2.7%. So, not in the 2% sort of danger zone area. So again, real wage growth has been supporting consumer spending, and so GDP has shown some resilience. But as we just discussed, I do think that there are some warning flags when it comes to the U.S. consumer.
So I would dotted line in next quarter to probably deep below your trend line,
Is that your
just because of the
forecast?
shutdown. Yeah, that's my forecast right here. Um, but yeah, that makes sense. So really, you don't see the recession at least right now, but um, there's some headwinds that are that can force that trade line to go below 2%.
Exactly. So I would certainly not feel comfortable saying that we're in a recession right now, or even, that we will be in one this year. But we're monitoring some, especially the labor market, to see if there's further deterioration next year. And if there is, that's where I would get a little bit more concerned about risks of recession rising.
Makes sense.
And what all that means for the Fed, since that's where we started on the macro portion, is we know that the Fed just cut rates for the second time this year in their October meeting. And in his press conference, Chair Powell emphasized that another rate cut is not a foregone conclusion, and that decisions will really hinge on incoming data and evolving risks. So the market certainly believes that we will be getting another rate cut in December. So these are market expectations of the number of Fed rate cuts by the end of this year and then by the end of next year. And as you can see, our current rate is I've put this right here, so 375, 400, and 67% of market participants believe that we'll end the year at 350. So another 25 basis point cut in December is what the market is expecting at the moment, and then maybe a couple more next year. So the market is expecting Chairman Powell to prioritize the labor market side of the mandate and really prevent a job loss recession, and believes that the Fed will sort of see through potential tariff-driven upward pressure on prices at the moment. And
For that, they'll definitely need to open the governments so the feds can get the right data to make the right decision. Otherwise, they're again operating somewhat blind and
in the
they're
fog.
using their gut. Yeah,
Yes, in the fog. And, there was also in the last meeting some nod to short-term liquidity concerns. The Fed stated that they'll conclude its quantitative tightening or balance sheet reduction program on December 1st. And so, the Fed will continue to allow mortgage-backed securities to mature, but reinvest those funds into treasuries, which basically allows the Fed to reduce net holdings of mortgage-backed securities, but hold the size of its balance sheet relatively constant. So that was the other announcement in the October uh, Fed meeting.
so that should help the economy, right? So if they don't tighten anymore and that they don't print money through the QE, um, I guess they want to see what's going on with the market, and if the new Fed chair is coming on board at some point, they'll have to make some decisions on which way to go about buying or selling or just letting all the MBSs to mature.
Yeah, they also sort of mentioned that they want to reduce their long duration holdings in favor of more short term debt. So a lot of change to come from the Fed's perspective. But in terms of what that all means for mortgage rates, we've seen mortgage rates steadily come down. We're at 6.2% in the latest available data. And as we all know, the mortgage rates aren't tied directly to the Fed funds rate, so the Fed's decision. Instead, they're loosely benchmarked to the 10-year Treasury yield, which moves around for all sorts of different reasons, including inflation and inflation expectations. So last year, when the Fed cut rates, we saw mortgage rates decline in anticipation of that rate cut. But then once the Fed cut, mortgage rates actually went up because the market actually had some inflation concerns. This time around, we're seeing, mortgage rates have steadily come down. And for me, one of the things that's been one of the most positive developments this year is that spread between the 10-year, the mortgage rate and the 10-year Treasury yield has continued to sort of come down towards normal. So historically, the spread between the 30-year fixed rate mortgage and the 10-year Treasury is at about 170, maybe 200 basis points. At the height of uncertainty in 2022 and 2023, the spread increased to 300 basis points. And today, it's closer to 210 basis points. So to put that in some perspective, if the spread was still at 300 basis points, given today's 10-year, mortgage rates would be above 7%. If it were back to the normal spread of 170 basis points, we would be closer to 5.8%, which would be nice. Instead, we're currently sitting at about 6.2%, so trending in the right direction. And I think the takeaway here is we don't necessarily need the 10-year to drop sharply for mortgage rates to improve a little bit more if we see a continuing narrowing of the spread. I don't expect a return back to 170 because of ongoing prepayment risk and volatility, but this has been one of the more positive developments this year, I think, is the narrowing of the mortgage rate spread.
One thing that I think contributes to the spread is a shrinking market for the mortgages, and the mortgage companies, especially fintech, are eating away at some of the usual suspects on the market, creating a lot of pressure on the originators to give the lower rates and operate on the thin margins. I think that I've seen that in my companies where we are inventing in that space, and we are doing whatever we can from the originator perspective to lower the limited amount of borrowers to refi or purchase in the downward market.
Yeah, that's a great point. But, interestingly, the forecast in the industry right now for mortgage rates into this year and into next, and I would generally align with this perspective, is that the consensus is still rates above 6% by the end of next year.
Yeah.
So not a lot of folks saying that we're going to get rates dip below 6%. I do think we're sort of in this new normal of elevated rates. And when it comes to affordability, and hopefully we'll get to that, we need prices to come down, income to continue to outpace price growth to really bring affordability to a better place.
I agree.
All right, I'm going to skip for the sake of time, go to demographics really, really quickly because we have touched on population growth. I do think it's important to bring up population changes throughout the country because they have implications for housing demand. So population change is simply defined as the difference between new residents, so that includes newcomers from other states, international arrivals, and births, and those who have passed away or moved. And in 2020, net migration from other states and abroad overtook natural change. So the difference between births and deaths as the leading factor driving population gains and losses, both nationally and across most states. And by 2024, domestic and international migration had become the primary driver of population growth in every state except Alaska. So what you see in this chart is the percentage change in population from 2023 to 2024. The darker the green, the more population growth, the darker the blue, the less. Florida obviously stands out with the highest overall population growth rate, driven by the highest rate of international migration, followed by Texas, Utah, South Carolina, Nevada. The Sunbelt markets clearly outperforming here. Even if there are markets where population growth has slowed compared to the pre-pandemic surge, this region still leads. And I think when we zoom out and we look over a longer-term horizon, growth has been more sluggish in the Northeast and Midwest, while the South and West have consistently led. So we've seen a big drive towards the Sunbelt markets over a longer-term horizon, obviously driven by employment opportunities, lower costs of living, and, better weather, I guess. A little bit more sunshine.
Arguably. Yeah.
Yeah, I think so. As someone who grew up in upstate New York, I can confirm that we don't get as much sunshine. So we know that states with fast-growing populations typically, experience more housing demand. And so I always like to show this chart because I think it helps to explain why we saw such great demand for housing in these Sunbelt markets over the pandemic. We're in a slightly different market now, where I think, Florida and Texas in particular are struggling because with all of that population growth came builders, and they started to build more homes and in response to that demand. And now there are some markets in Florida and Texas where we're seeing a lot of inventory buildup, which is now putting downward pressure on prices. And as I mentioned, Florida had a lot of population growth, but a lot of that was being driven by international migration. And if that slows, that certainly has implications for the demand side of the equation.
Understood.
On the demographic side, this chart hasn't changed very much because it's annual, but I think I brought it up last time. I still think it's worth mentioning because demographics are so important when we talk about housing demand. And I'm still out here trying to disrupt the narrative that millennials are, the forever renter generation, the avocado toast generation. They're like spending all their money on avocado toast so they can't afford a home. And in the data, that's not what we see. Yes, it is the case that at the same age of 30, millennials, the homeownership rate for millennials was significantly lower than their generational predecessors by about 6 percentage points, actually. But then when we go up this age curve here, that 42-year-old millennial, they've pretty much closed the homeownership rate gap compared with their generational predecessors, the Gen Xers. The other interesting trend here is the Gen Zers in the yellow line. You might think, whoa, Gen Zers really outperforming everyone in their early 20s. But I think this is an exception. Gen Z started to buy homes in their 20s during the pandemic housing market, which is, when mortgage rates were 3% and we didn't have to go downtown and we were sort of untethered from the downtown office. When you look at the older Gen Zer, their trend is more aligning with the millennial trend.
What's the average age for first-time home buyer in this year? I heard some controversial numbers. It's did I see somewhere over 40-year-old now is a first-time home buyer, and then I always thought we're around 30, 33-year-old for the
It
first-time home
depends
buyer.
on the source. So the number you cited is definitely out there. There's, late 30s. I would say generally, if earlier generations were buying on average in their mid to late 20s, millennials are buying in their early to mid 30s. So that the decision to buy a home has been pushed to later in life. And part of that in this economy is obviously the affordability constraints, but I think a lot of it is choices, lifestyle choices. Millennials are getting married later, having kids later, staying in school longer, and that pushes the decision to become a homeowner later in life. But what we're also seeing is that millennials sometimes skip the starter home because they have been, they are highly educated. They are seeing that education pay off with higher incomes. And so when it does come time to buy that home at 40 years old, they're able to skip that starter home and just jump to their forever home or their second home.
Makes sense. Yep.
And then we just updated our forecasts for households and homeowners through 2060. And we thought this was important because we're clearly in this period of demographic change. Millennials are in their prime home buying years. Gen Z is, close behind them. And then we've got younger cohorts like Alpha and Beta, which will eventually add to housing demand. But at the same time, we've got baby boomers who hold a very large share of existing homes. They're staying in their homes longer, which limits turnover, but we know they will eventually age out of homeownership. So, we've got these dual forces of younger buyers and the eventual transition of older homeowners that are really shaping the housing market for the next several decades. So this chart is showing you projected household trends from 2025 through 2060. What it's showing you is that millennials alone are expected to add nearly 11 million homeowners as their homeownership rate climbs from just over 50 to over 70%. So there is sort of this long-term tailwind for housing demand from this generation. Meanwhile, for baby boomers, over time, they will move to smaller or care-oriented settings, and natural attrition will reduce their numbers to about 1.5 million households by 2060. That transition will add a steady supply of larger, very well-located homes for the next generation of buyers. And overall, what we're seeing is that the number of households is expected to grow by about 18 million, so about 13% over this time horizon, while homeowners will increase by about 8%. So I think these are, and this can change, obviously, immigration can change what this looks like, but I do think it's an important chart to keep in mind when you're thinking about your business or what the outlook looks like for housing demand and supply.
Yeah, one comment on this slide is I think it's a great lead into affordability index and the upcoming home buyers being able to afford the real estate at the current prices, and whether they're looking at smaller homes, not 4 bedroom, 2 bath, but it's
Mhm.
2 and 2, or um, tiny homes or modular homes. So that trend would certainly be interesting because the prices are not falling fast enough on the real estate side, and it still makes sense to rent. There's still a huge gap between the rent amounts versus the payment for the home, plus huge increases in insurances and taxes and flood insurance and escrows, etc. That still, doesn't translate to the right math for somebody who rents to go and buy a home.
Yeah, and that can be a significant hurdle in some markets more than others. But I think you're right. House prices are downside sticky. We're seeing that despite the fact that we're at 6% mortgage rates, house prices aren't really budging, and that's because homeowners can choose to not sell if they're not in a position of distress. They can choose to wait out the market if they don't feel like they're going to get the price that they want. I want to touch a little bit on the supply side of the housing equation. But first, I wanted to start with the fact that the elephant in the room, which is that sales still may remain very, very low, right? If you track the NAR existing home sales report, you know that we've been stuck at a pace of 4 million annualized home sales for the last couple of years. And I think that sort of begs the question, well, what should we be at? What is normal? And that's a tough question to answer, but one way that we like to look at it is by looking at sort of the size of the pie. So when we talk about 4 million annualized home sales and try to compare it to years past, we think that that's misleading because it's like comparing apples to oranges, because the total number of households, which represents the demand for shelter, has grown significantly over time. So an annual pace of 4 million sales today is much weaker than 4 million sales 15 years ago because there's a lot more people. So what we've done is we've looked at historically what has been the share of existing home sales as a percent of total households, and we found that it was just above 4%. So if we apply that long-term rate to today's household count, it implies that existing home sales should be closer to 5.4 million in, a healthier market. That's about 35% higher than today's rate of about 4 million. New home sales are a similar story where, the latest numbers showed that we're at about 800,000, and given the size of the number of households, we should be closer to 9. And I think that this is an indication of sort of suppressed market participation, but not a lack of demand. I think it shows that there's still demand on the sidelines for home buying, but unfortunately that affordability constraint, that payment to paycheck calculation is just not where it needs to be. Um, and part of the story here is that we've been underbuilding for over a decade. So this chart is showing you how much we've been building new homes, single family homes, multifamily homes, and manufactured homes compared to new household formation. And anywhere above that zero line means we were overbuilding. So early 2000s through 2005, we were overbuilding. And since then, we've been underbuilding. And that's contributed to a housing deficit. The range, how big that deficit is, will really vary depending on who you ask. But the consensus is that we're short about 3 million units. And currently, we're only building, I think it's 1.3 million units right now. So even if all those units came to market tomorrow, it's not enough to meet the consensus shortage.
So that one thing that I wanted to add to this, based on these numbers, Wall Street saw the opportunity to switch from non-QM and private mortgages into build to rent. They realized that the prices are sticky. The affordability index is still, pretty high for somebody to go and buy a home. So you're not going to have a forever renter, but at least in the period of, let's say, 3 to 5 years, people will still choose to rent. And therefore, the transition from sort of a shrinking market on the standard purchase and refi, um, they make a decision to go into build to rent communities, right? So that's the next big investment that Wall Street is currently doing and transitioning to. And some of the bigger names are looking at this data and decided that this is the right strategy based on you know foreseeable future.
Yeah, and just given demographics and the fact that we have this massive generation of millennials who are, starting families and, maybe might need, they can't afford a home, but they still sort of want, the space to support their families. And so a single family rental might be the best option for them at the time. And this generation is massive. So I think that makes a lot of sense.
Yep.
Uh, we've talked about the rate lock-in effect at nauseum, I think, in the industry, but it's still very much alive and well. The latest data shows that 80% of mortgaged homes have a rate below 6%, but that rate lock-in effect is easing. Consider that in the second quarter of 2022, 93% of mortgaged homes had a rate below 6%. So we do think that the rate lock-in effect will continue to be a drag and a headwind holding back transaction volume next year, but it is a headwind that is weakening as life events spur home sales and slowly but steadily erode the number of homeowners that are rate locked in. And so we expect the easing to continue, but still, remain a headwind into next year. And, probably beyond because we locked a bunch of people into 3% mortgages. Uh, in terms of inventory, I think the picture is sort of mixed in that historically, 25 in every 1,000 homes were for sale. Today, it's more like 14. Um, so still historically low, but if you look at this inventory turnover number, which is, how many homes are for sale relative to sort of the stock, it's been increasing. So we're seeing new home inventory certainly rise, but we've also seen existing home inventory rise as well. And that gives buyers more options. That inventory is concentrated in places like Florida and Texas at the moment, where we're seeing a lot more inventory build up. But that should allow prices to gradually come down as well.
A couple of things I wanted to
Yeah.
comment on. I think on the prior slide, um, from what I hear from the conferences, um, buyers are now shopping for the rates and rate locks, and they are trying different sources. And out of two applications that the same borrower sends to different sources, only one will be successful. So you'll see about 50% drop in the application locks or rate locks, right? So and they can do it until the very last moment before they actually commit to buying the property. So I see 50% drop in conversion of the rate locks. And then second thing is on the um, 3% mortgages. The latest that I saw in the industry, the ARM mortgages are back, right? So now it looks like 11% of the total market is ARM, which is pretty dangerous, and that's what sort of caused one of the sources of great financial crisis. But if everybody thinking the rates will drop and ARM is not a bad idea, but at the same time, if the rates will start going up, we'll see a lot of defaults.
Yeah, the we can see from the MBA applications data that the share of ARM applications has been rising, still well below global financial, crisis levels. I also think that there are more guardrails in place. This is not your Great Recession ARM. There are more guardrails in place to prevent that sort of sticker shock from potentially higher mortgage rates in the future.
Yeah, makes sense.
Um, so it's interesting. I think those are a little bit outdated, but it's interesting that you mentioned the mortgage applications, because I think one of the data quirks that the industry is grappling with is, for those of us that track the mortgage applications data, we can see that it's been steadily rising, responding to lower mortgage rates, but we're not seeing it in the existing home sales data, and so people are sort of like, well, wait a minute. Usually these things track each other. You have higher mortgage applications, you see higher sales. I think part of that story is sort of what's happening with the cash share of sales. There's that part of the story. But I think the other part is sort of what you mentioned, which is, are we seeing all of those applications transition into sales? I think part of it might be cancellations, and part of it is denials on the part of the of the loan officer. So I think both factors are at play right now, and why we're not seeing higher applications translate into more sales activity.
Yeah, and denials, from what I hear, just to comment to what you said, is mostly related to appraisals, right? So appraisals are not coming in the right value with the selected areas of the country that you showed on the bubble map. A lot of places saw a decline in real estate pricing, and if you're trying to buy a property based on the listings price, appraiser projects the value to be lower nowadays than the market, and just there's no match. Is that what you see as well, or there's more income related things or other things that you're tracking?
A lot of it I'm hearing it through anecdata mostly. So just from people in the industry, and I think that's certainly one part of it. I think borrower profiles as well, I think is contributing to those denials.
Interesting.
Yeah,
Do you
and
have
this is
yeah.
sorry, go ahead.
No, would love to also dive into, before we end up closing our podcast, home affordability, right?
Yeah,
So,
that's exactly I was gonna skip through the new home side of the market because I think it's still a relatively small share here and go to, even if it is for sale, can you afford it? Because affordability is a big question mark in today's market. In this chart, I just like to show that yes, we're seeing markets with price declines from the peak, and the peak can vary depending on where you are in the country. But at the top part of this chart, we're tracking how much home prices increased from February 2020 to the peak. And then in the bottom portion, we're tracking how much prices have declined, if at all, since that peak. What we found is that in 34 of our top 50 markets, we're seeing price declines from the peak. It's most severe in Austin, Texas, where prices have declined 13%, followed by San Francisco, Phoenix, Tampa. So either pandemic darling markets or markets that are traditionally more expensive, like San Francisco, where the increase in mortgage rates sort of disproportionately impacted affordability in those markets. But the remaining 16 markets are still growing, and those are concentrated in the Northeast or the Midwest. So Boston, a place where we don't build very much, they're still seeing a robust price growth in Boston. I think the other thing to note here is even in Austin, where prices have declined 13%, prices increased by 65% over the pandemic. So for those that purchased during that sort of appreciation period, they're still sitting on quite a bit of equity from that period. I think where I start to worry is people who bought sort of at the peak, with lower down payments and now are experiencing price declines. And if the labor market slows, I think that that's a recipe for distress in some pockets of the country.
which will translate to uptick in foreclosure scenarios.
Yes. Which is still right now historically low. And I
Yeah.
don't expect a big foreclosure wave because there's still so much equity and the labor market. We're not seeing mass layoffs. But again, for those people who bought in markets where prices are declining and they didn't get to benefit from that pandemic appreciation, and if the labor market slows, I think that that's a little bit of a concern.
Also, this slide would tell us that people are starting to tap into their home equity through the HELOC close in seconds, home equity investment products, and that should really translate to the data on what you're seeing from the First American side as well.
Yes, we are seeing an uptick in HELOCs for sure, which makes sense just given the equity that we see in the market. The good news for some of the places with price declines is that in the markets we're seeing price declines, we're seeing improvements in affordability. So the way to read this chart is the bottom left-hand quadrant are markets where we're seeing price declines and also markets where we're seeing affordability improve. So take a look at Miami, we're seeing price declines between 3 to 4% on a year-over-year basis, but affordability is improving by, 15 to 16% on a year-over-year basis. Contrast that with markets in the upper right-hand quadrant, which is where price growth continues to remain positive, but you're also seeing declines in affordability because, again, that price growth makes it, all else held equal, less affordable in that market. So again, another regional divide here. You see markets in the Sun Belt markets that are experiencing relative affordability gains, whereas the Northeast and Midwest continues to get more expensive. So yeah.
Next quarter, let's monitor for New York bubble, which is the biggest bubble of your chart, to move to the negative territory. That's my bet. But that's going to
We've got a
be
couple of
interesting
your
to see.
forecasts on
There you go.
record now. So
Good.
and I think the thing that's interesting here is there's a third dimension of active inventory, which is, the markets where we're seeing price declines are also markets in general where we see more active inventory buildup, which is contributing to some price cuts, which again improves the affordability picture. The other way I track affordability, and I decided because we're in football season, I would put this all in terms of football divisions. But basically, I tracked all of our markets for renter affordability. So, how much can the median renter afford in their given market? And this matters because typically when we look at affordability measures, we're looking at median or average income, which combines the income of the homeowner and the renter. But on average, the homeowner's income is twice as high as a renter's income. And affordability, by definition, matters for that potential home buyer, which is a renter. So I ranked ordered this by the most affordable markets and division. So our most affordable division is the AFC South, with Jacksonville coming through as the most affordable market within that division. And then unfortunately, on the flip side, we've got LA, where that median renter can only afford about 2% of homes available for sale. Nationally, the median renter could only afford 26% of homes for sale.
This is great. I love this. Tying the NFL to the housing affordability index, only you can do it. You know, it's there you go. Well, my team is Eagles, Phillies, and how are they doing there? I think they should be in the.
Actually, okay. Yeah, you're right here. So this is one of the more relatively affordable markets, and interesting to hear you're a Philly fan. My boss, our chief economist, is a Philly fan, and I'm a Buffalo Bills fan because I grew up in upstate New York. And when we went into this analysis, we assumed Buffalo would be more affordable than Philly. And so we had a little bet going. And unfortunately, that was not the case. I lost that one. Philly was a more affordable market, but I told him I'd see him at the Super Bowl. So we'll see.
That's right.
The other thing we can do actually is track this at every point in the distribution. We're always talking about the median or the average, but how is, the poorest or the lowest income renter doing? How is the Bill Gates of renters doing when it comes to housing affordability? So what we can do on our, and we have all of this up on our Econ Center, is we can track everyone in the income distribution for our top 50 markets. So if you're here, in LA, you are the 100th percentile renter. You are, at the top of your income distribution in terms of renters. If you're down here, you're in the lower income bracket, and you can track, well, how well can the 10 percentile renter do in Philly? Can they afford 10% of homes for sale, which would put them on this line of equality? Can they afford less? The closer you are to this line of equality, the more affordable the market. So what we've done here is, Memphis is a relatively more affordable market where that median renter can afford about nearly 40% of homes available for sale. And then poor LA, where that median renter can afford about 2% of home for sale. And, Philly is somewhere in the middle here. We'd love to see a market that's closer to that line of equality where everyone in the income distribution can afford, sort of their share of homes available for sale.
So LA folks can only dream about owning the home, while folks in Philly can actually own one.
Yes, yes. And then, we talked about insurance premiums, and we have some data, arguably dated because we're reliant on some survey data, but I think it's still indicative of the trend, which is that, between 2021 and 2023, homeowners insurance premiums increased by more than 20%, adding about $300 per policy each year, which was outpacing both income growth and inflation. And that surge has been concentrated primarily in the South, where premiums increased by an average of 25% from 2021 to 2023, adding about $425 per policy. Coastal cities have been especially vulnerable because they're more vulnerable to tropical storms and hurricanes. So New Orleans premiums have increased by more than 50%. And the increase in insurance premiums has multiple drivers. Obviously, the increased frequency and severity of weather events,
Natural disaster. Yeah.
natural disasters has been contributing, rising reinsurance costs, concentration of populations in more higher risk areas, as we talked about in the population charts with growth in Sunbelt markets. All of these, I think, are drivers of the higher insurance premiums. And this is an issue for both potential buyers, but also existing homeowners, especially those on fixed incomes. Even if you've paid off your home, if you're still paying for insurance premiums that continue to go up, I think that's a real challenge.
I hear in some places insurance premiums equal to the mortgage payment. So that's pretty unfortunate.
Which is so difficult. But to end on a positive note, I think that affordability has been improving and will continue to improve. We know that right now, income growth is outpacing house price growth nationally. And house price growth, according to our First American Data and Analytics Index, is in the single digits, so at the slowest pace since 2012. Income growth is outpacing price growth, and we're seeing some moderation in mortgage rates, and all of that should continue to contribute to a modestly improving affordability environment over time and into 2026. So that is my good news. And then, of course, my last chart here is like, where are we in the cycle? And pick your point, but I believe we're sort of we're past despondency. We're entering, sort of about to hit the hope. We're hopefully entering a new real estate cycle. I think it'll look a lot different than the last cycle, but we'll start to see some steady pickup in home sales activity. We might not get to that 5.3 million that I mentioned earlier, but we'll start to make some incremental progress. So.
The reality will kick in, and we will go from uncertainty to certainty next year, right? That's our message to people that are watching us.
That's right.
Odetta, I wanted to thank you for your time. It's great info. I'm looking forward to our next session in Q1 of next year. Let's see if our predictions will actually materialize. And looking forward to seeing you on the next conferences.
Likewise. Thank you for having me. See you again soon.
Thanks, Odetta. Take care. Bye.